Now this is much more natural and much more powerful. So I like silver a lot right here, literally today. You can't miss this move. You need to participate. For someone like me, that I'm not missing this move because it's going to be huge. 49.45 is the next upside target for gold in my mind. That's going to take a while to get there. But I mean, if gold's going to test 4,000, I have no problem seeing silver testing $100.
Hello, everyone. Welcome back to the Daily Gold YouTube channel, and welcome back to the Daily Gold podcast and Macro Mondays. Well, you guys know that I'm not a huge fan of a lot of macro analysis. I find it to be tedious and a little too long and boring. But I always like to say when it comes to macro and gold, nobody does it better than Greg Weldon, and that's why I'm bringing him to our audience. Greg, thanks so much for coming on. I know you got a tea time coming up, so I don't want to waste your time. But first things first, Greg. With respect to macro, I know this I could take you in like 10 different directions, but let's just start off. What do you think is the most important macro thing that people need to know, or the most important macro insight that you have right now as we're going into the summer?
Wow. Yeah. Okay. We have 3 hours. So I can answer that question. I think if I have to put anything at the top, it really is the macro situation and how it will impact the dollar. So to me, the most important marker right now is the dollar. And while you could probably always say that per se, it's very important right now because it's breaking down. It's breaking, and it's the reasons why it's breaking down. It's multiple reasons. So that's why we could talk about this for 3 hours, because it covers every kind of really key macro point, from a trade dynamic with the world where we are pushing Europe to become friendly with China. We have China talking to Japan about trade, for crying out loud. We have pushed the world away kind of from the US in terms of the dollar, all right, in terms of a BRICS unit, which has gone on the back burner in the public eye. But since Trump has started pushing, and now you have China talking to Korea, to Vietnam, to some of the places where there's been some conflict, that this is making the push for the BRICS unit for all these countries much more urgent. So that's number one. Number two is really what would be the answer to your question, which is U.S. debt having crossed over what I call the macro event horizon, that we are in a debt black hole now, which means we have to print more money to keep the economy going, or we will have a debt deflation, which they will avoid at all costs. They will choose to reflate every time. And you are now in a situation where you have a bond market crisis potentially looming. So to me, looking at the supply demand in bonds, looking at the fact that the 30-year is pushing 5%, and looking at the fact that the dollar has now made a secular breakdown, which finally, has broken silver loose today. And we put out a recommendation around 4 o'clock this morning to be aggressive on the long side of silver. We put out a piece last week on the silver mining shares and the SIL, and they're just, kind of went a little crazy today. It's funny because I put out, I have several very large hedge fund clients, including some very well-known names that you would recognize instantly, including the big firm that just moved down here to Miami, not far from me. It's one of my biggest clients. And I just find it odd that 2 weeks ago I put out a buy rec on platinum, and within 2 hours, platinum was up $50. And I put out a buy issue on silver this morning, and the next time I look at it, it was like up $1.40. So I'm starting to wonder, if maybe some of my bigger clients, these markets, you can push around a little bit. So I find it interesting. I'm going to have to really be careful with, how we approach this from here on in. Because, when you talk about a market like silver, which is squeezable, cornerable, all the different things that you always talk about with silver that now become maybe more pertinent on an immediate basis. And, I think some of my clients have the capacity to push this market around a little bit. So, we got bullish, and the impact was pretty immediate. Now, certainly there have been times when I've turned bullish, and next thing you know, silver's down $1.40. So, you never know. But I think the time is right because the dollar is breaking down. And everyone has said to me, why is silver so frustrating? Why is this action in silver so lame? Why has the gold silver ratio gotten out to where it is? It's a simple answer. Central banks are not buying silver. They're buying gold like crazy. You don't see open interest on gold and the COMEX rising. In fact, it's falling and breaking down. Only now has this become a rotation of U.S. Wall Street money into the mining shares, which I think is one of the biggest things that we see happening in the markets as it relates to the precious metals. And that's huge to me. And I said beginning of the year that this would happen this year. It would be a major rotation, and it would be the thing that really lets loose these mining shares to, uncover some of the value, which is in these shares that people don't seem to be, anxious to take advantage of. I think that Peter Grandich, a well-known metals guy, he said it first that I heard it, and it was so simple that I like to use it, but I always credit him. But it's really simple. I mean, some of these gold mining shares are printing money with gold at these prices. And you will get there with silver too. I think today was the first day in a much bigger move in silver.
Yeah, Greg, there's so many directions I could take the conversation in, but I completely agree on the mining shares. If you look at the margins that they have right now and the companies, I mean, I focus on not tiny companies, but smaller companies, and you look at the ones that can grow production in the next year, 2 or 3 years, they don't even need margins to go any high. Even if margins went down 5 or 10%, these companies are going to fly in the next year, let alone what happens if gold goes to 4,000, 5,000, or even, ape shit beyond that. But I don't want to get too far ahead. But yeah, let me circle back. Let's talk about the mining shares, because I noticed this in the last couple of weeks, and I kind of expected this, not to scratch my own back, but a month ago I was thinking this could happen, where there's just so much money. I mean, you've talked about it. There's so much money out there that's under position that needs to come into this market. Really strong fundamentals, strong technicals, and so the miners, both silver and gold stocks, they've been outperforming the metals. I think today you see the indices, the ETFs, they're making higher highs. Gold and silver are not there yet. I mean, silver's really close, but I mean, talk to me about what the significance of that is. The miners starting to lead. Does that mean more money is going to come in? Does that mean the metals could really explode in the next few months? Again, I don't want to put words in your mouth, but Harry, what we see, that's what's going on. What's your takeaway and the conclusion from that with respect to what could be coming down the pipe the rest of the year?
Sure, it's pretty much everything you just said. I mean, we've had this discussion before, and I've been saying this since the very beginning of the year. One of our top themes going out this year would be a rotation of capital out of the leadership in stocks in AI and tech and into the precious metals, which nobody owns. You have a Fed that's going to be forced to acquiesce to higher inflation. Even in the most recent Fed minutes, I haven't heard anyone talking about this, but there was a discussion in the Fed minutes that were just released last Thursday, I think it was, which discussed, changing the approach to targeting inflation to potentially having a range. And we've talked about this before. It's something that's going to happen. It will make it a lot easier for the Fed to rationalize what they have to do, which will be acquiesce to higher inflation and protect growth, because without growth, you have a debt deflation. They will choose inflation over a debt deflation every single time. Been saying that since 2006 when I wrote it in my book. Staring into that abyss, you will choose to reflate. So that is the driving force in what will be now. What is going to be the next leadership in the equity market could be precious metals, because nobody owns them. They're a tight market. It's not well capitalized, relatively speaking. So, a small amount of money could drive these stocks dramatically higher. You already see what's happened with something like the Anglo-Ashanti. I mean, it really has taken off. Newmont has come to life. Barrick has come to life. These are the big three to me. So you see the rotation of capital there. And even, kind of beyond that, when you start to talk about how what I call the ladder of performance, you need to climb the ladder, okay? And what you want at the top of the ladder is the junior gold miners, and then the miners, or really the silver miners, then the junior gold miners, then the gold miners, then the metals. And then, so you want these things to stack up. And right now, they're stacked up for the first time in a while, where literally the GDXJ is outperforming gold. All right. That is huge to me. Breaking out on a long-term basis, violating like a 15-year downtrend line. These things are huge. But not only that, you are talking about the GDXJ, the junior gold mining share, and now even the SIL outperforming the XLK, which is the S&P Information Technology ETF. Hello, do we need to really make this any more difficult than to just look at the simple performance, the volume and on-balance volume and numbers, and the rotation of capital here? So yes, I think that this is very early stage. And when you talk about the margins and this, that, and the other thing. There's another little kind of tangent off of that, which is think about some of the mining shares that don't really produce gold yet, but are sitting on properties where there's gold there. What's a better takeover candidate for some of these new companies like a Newmont or even like, especially like an AngloGold Ashanti, which is flush with cash now? Go out and buy places where they can come in and more profitably, efficiently, and effectively get the gold out of the ground. All right. Rather than, these companies going out looking for their own financing. I think there's a lot of potential takeover, merger and acquisition type of activity that could drive this market into a frenzy. I think that you haven't seen anything yet. And when I look, one of the real ways to watch this and monitor this is to watch the open interest in gold futures. It's falling. It's at a very low level, considering that gold is not that far away from record high prices. And then, of course, the rotation we're seeing now into silver would be really very important part of this ladder, because silver should be at the top. Silver hasn't been at the top, but silver has a chance now with the dollar declining. That was the only thing missing. Because again, like I said, central banks are buying gold. They weren't buying silver. But now the dollar's breaking, investors will be buying both.
Let me do a quick follow-up on open interest, Greg. So tell us the importance of that and how you use that and how we can use that.
Yeah. It's not always perfect. I mean, there's nothing that's really perfect. That's why I love to get everything top down, macro, bottom up, technical, and have everything mesh. And that's when you put risk capital, to work. In the case of open interest, it merely is the number of contracts outstanding on the futures markets. And typically it's pretty simple, but again, it's not always black and white. There could be various reasons things happen. Generally speaking, when you have a market that's going higher and open interest is rising, that means you have fresh money coming in on the long side. The flip side of that is when you have a market that, like we just saw, goes up and then kind of comes down pretty hard and open interest falls sharply. That's a market that had a lot of longs that people liquidated. So you look at this, the flip side is a market that breaks down and open interest is rising. That means fresh shorts are coming into the market. And you can also get the commitment of traders report, which is put together by the CFTC, which is the SEC of the futures market. And it will give you what the trade is, whether the producers, whether the miners, and versus the speculators versus the hedge funds. So it breaks it down by each category of trader so you can see what their net positions are. And why is this important? Well, obviously, if you have a market that's about to break out, or a market like gold, which has had this huge run. And I said this, literally a year ago, because the very first breakout, there was no rise in open interest. And I was shocked. And you see the on-balance line, which measures the buying seller versus the buying power versus the selling power, was rising. So you have open interest is like this, and the on-balance volume is like this, which meant it was just a lack of sellers. It didn't take a lot of buyers to drive this market higher. And I said at that point, look, you're going to be in a position where this market's going to be at record highs. This is still when it was, like below 2000, like 1900, 2100. But you're going to have a market that's at record highs and people are chasing it because they don't own enough. And I still think you're in that situation, like the disbelief kind of almost from the speculative public on this is that gold is too high and they don't want to buy it. On the other point, I will say this. I bought silver this morning, first thing before it even moved. And I wanted to buy gold too. The problem with gold is like these moves now, okay, because of the whipsaws you have from the politics and all kind of the trade issues, right? That the stop for me would have been $120 away. Okay. That's half of the price of gold when I started a business. Is now the stop, okay, that you need to risk that much money, which on one gold contract, futures market is 100 ounces of gold. That's $12,000. Think of someone that has 100 grand trying to manage these markets. You can't do it. The risk of ruin is too high. One trade, you're out, 12% of your money. So managing the risk has become more difficult. I will say that too. And sometimes the opportunities kind of fall by the wayside because the risk is too high. And for me, I can tell you doing this for over 40 years, all right? I don't get upset at losing trades, okay? Because we put stops in the second we put a trade in. I know exactly what my max loss is going to be on any given day, any given position, outside of something, a black swan event happening. Of course, you can't guarantee losses can be limited ever. But having said that, it's more difficult now to put positions on that within the range of risk metrics that I like to use because I'm a very low risk trader. And that's why, we manage money as a CTA Series 3 registered. I mean, that's why it's $1 million minimum. And people are like, oh, it's $1 million minimum because you get your higher fees that way. It's like, no, because this way, when I want to basically have a 0.5, 0.6 maximum per trade risk, I have enough money to work backwards and back engineer my risk profile to use the overlay I need to make sure my risk of ruin is as low as possible. So I say that it's difficult for average people now to kind of play the gold market, and that might be a reason why open interest is low, because the risk on any given day is huge in dollar terms.
Greg, that's a very important point. I want to delve into that a little bit more. I know you covered it a lot there, but it really interests me because with respect to not silver, because we know it's a great opportunity, and gold as well, but with respect to gold and a lot of these gold stocks, even for you or the average person or for me, it's so difficult because they've already made big moves. Yet when you're looking at the 50,000 foot view, these things are going to move way higher in the next few years. But you're looking right now, some of these charts look like rhino horns. And I always tell people, don't buy the rhino horns. But again, the value is there, but they're so overbought in the short term. Yet, as you're saying, there's no sellers, there's no selling pressure. They almost have to move higher. It's just so difficult for people who are not invested at this point. I mean, do they just buy like in drips and drabs? I mean, can you add any more color or guidance on how we can approach the situation? Again, whether we're looking at gold or a certain stock, it's like, God, I know this could go up 3x or 5x in the next 2 or 3 years, but it's gone up so much in the short term. It's just, it'd just be risky. It feels like I'm gambling here.
There's going to be added risk. There's no doubt about that. But the reward is also, commensurate. So I would say there's two ways to approach it, or at least the way that, that I do. All right. Number one is to shorten your time frames. So if, for example, you're using a weekly chart or a daily chart, maybe go to an intraday chart and try and find the swings that will allow you to minimize that risk within some kind of context of what the discipline is. For me, that means simply, okay, maybe narrowing the volatility bands a little bit, or using a little bit, honestly, expanding the risk a little bit. So I like to keep my risk under 0.5, but there are times now when, hey, look, it's about risk reward. So if the reward is there to risk 0.6 or 0.7, now I'm having to do that more often, and it does pay off. But at the same time, that means there will be more volatility to the portfolio. So that for people that can't, handle the day-to-day swings, this is not the market for you. That's for sure. That's why it's probably best for most people, I would say, listening. If you want to be involved into the best, most efficient way, other than being a long-term investor, where you buy and hold. And let me get back then to the second way you will go about doing this potentially, which is to look for the new golds or the first majestics out there, which have not moved, have had some reason why they didn't move, where they're a lower price. I mean, I bought a bunch from my personal account of New Gold and First Majestic just because the prices were so low and because they have history being much higher. And yes, there are issues there, but at the same time, these are things where you can buy it for $5, $6 and just put it in your back pocket, and you risk 100% of the money you put into it as if it's a call option. And to me, that's just a really neat way to do it, because you're buying a $6 call option on gold that has no time decay, no expiration date. You can put in your back pocket and say, I'm going to risk this many thousands of dollars. You buy that many shares and forget it. All right. So that would be one way to do it. The other one would be to shorten your time frames and maybe constrict some of your volatility measures without, increasing your probabilities of being in and out. And that's tough. I mean, you really have to kind of know your math to do that, because for me, a trading decision to be long or short is everything: macro top down, technical bottom up, psychology in terms of positions and how the market is looking at things, and I want all of those things to converge. So from that perspective, shortening the time frames is the way to go.
Yeah, and I'll just follow up with what you were saying. Firstly, about stocks like First Majestic and New Gold. That's very important because those are stocks that the big money has to buy. Like when they're coming in, they have to buy that. Now, in my world, which is a little smaller, the mistake that a lot of people make, and I've made this many times over recent decades, is you pick something that's maybe 5 or 10 cents. They have a lot of gold or silver, and you think, oh, this has to move, and eventually it will move. But when money starts coming into the sector and big money, they have to buy the stocks like the ones you're mentioning. They're not, if you're looking for the absolute bottom of the barrel, you don't necessarily want to do that. Look for stocks that are big enough where there's volume, there's liquidity, and those are the ones that the capital that's coming in, it has to buy those. It
Yeah,
has to
and that's
buy those.
important. That's important because, and this is what we said, to watch the big three at the beginning of the year. So look, if you see Newmont, Anglo Ashanti and Barrick start to move, and they had been big underperformers. I mean, this whole thing has been upside down. You had the juniors kind of break out first, right? And the big caps were really severe underperformers. Newmont was a piece of garbage for a while. And yes, the big money Wall Streeters that are going to push this market around to the upside in the biggest way have to buy the names that are recognizable, the names they feel comfortable with, the names they know. They're not going to go out and buy the $2-3 shares. No doubt about it. You're right on. And that's a really important point. But it also is kind of the point that we're making to show that this tip of the iceberg is just now being seen in terms of the amount of money that can flow into these shares.
So just to follow up on that quickly, Greg, because my larger question was, who's coming into the market in the last couple months? Are you starting? This is my habit of asking 3 questions at once, but I guess one thing I'm thinking about, are you, from your perspective, you have the biggest clients in the world subscribe to your research and follow you because you're the best. Are you starting to see, has it only been in the last month or two that they've really been starting to dip in to the market? Is that fair to say? Can you give us some color on that?
Yes, it is, because when you kind of think about it, pitching gold shares to like any of the big hedge funds is kind of, they almost don't want to hear it, and now they do. So yeah, I would say this is because, again, the move in gold wasn't a U.S. investor-based push. It really was a global central bank. It was Poland. It was China. It was all the countries that want to get away from the dollar. What are they doing? All right, China's still doing it, even just literally yesterday. Right, they're selling treasury bonds, taking the dollar proceeds and buying gold. And they're doing that because they need the gold to be held locally, which is why the London vaults are being drained, okay? It's because to be part of the BRICS, you need the gold in hand. It'll be all based on blockchain, and it'll be fractional, so that Thailand trades with, say, Vietnam. Those two currencies are involved in a way, and then gold and the renminbi and the other, the renminbi and the other currencies that would be part of this also. But this way, each country, it would be customized, currency transactions based on the countries, the trade, the math, the percentages, the imports, who was exporting. I mean, it can be so fine-tuned. It's why it's such a much better system than just using the dollar because we won World War II 100 freaking years ago, right? So to me, that is a big deal in terms of understanding why this hasn't happened earlier, number one. Number two, AI's been on fire. Okay, everyone owns the same shares. This is why I don't even necessarily, I like stocks here, because dollar goes down. It's the best thing for stocks is a lower dollar. The correlation is as tight as any correlation that exists. So stocks will go up. But when I look at the tech sector, I see a lot of extended, stretched long-term technicals. I see markets where they have come back in with a lot of volume on the buy side. These are heavily owned, high-priced, extended shares that are overvalued. So, yes, I think you continue to look for that rotation of capital, but I think it's only the beginning. And I think that now you're going to see a scramble, because you know how this is like a school of fish. You got to get the couple of fish at the beginning to turn, and then the whole school turns. And this is the way the hedge funds and this money management, the what I call Wall Street money, operates. I used to be part of that, and now I'm so glad I'm not. But at watching it, I know how it operates. And this is the kind of thing, where you will see this, where all of a sudden this will shift from, oh, you don't own the Mag 7 to what? You don't own any gold? We have no exposure to gold? Are you kidding me? I want exposure to gold. So I think this is early stage. You'll see a lot more of this. And honestly, if you look at like the GDX or the SIL, I mean, they're only just now. I mean, they had the first breakout, and then it was questionable, and they came all the way back down and tested beautifully the back end. I mean, the test was deep, but it was still perfect. And now the move's starting. I mean, this is just early stage, and I think that you will see this kind of mentality take hold where it was, well, you have to own the Mag 7 because everyone else owns it. You need to compete. You need to keep your job. You need to keep your assets to where you don't have any precious metals. And that's when you'll see the meat of this move. And we haven't seen that yet.
Last one for you, Greg. Silver, the technicals, the short to medium term. Because for me, I've been telling people it's all about 35. When silver gets above 35 and additionally 37, you're going to start to see it move. What is your sense?
Yeah, 36.50 has been my number the entire time. And we actually lowered that a little bit, which is I was working a stop for the last week, literally just above that little shelf. So we got flipped in on the long side, literally. It's like I said, 4 o'clock this morning, silver was up 20 cents. So I think this is the breakout though, because it correlates better with the dollar. So when you start to look at the silver in the context of the dollar, that's where this gets really exciting, to where the other times when silver was up here, the other times it got above these levels right here around $35 an ounce, the dollar wasn't breaking down. So these moves were destined to fail. And yeah, it was frustrating. We all watched it. And the thing about it was, look, if you got above, and you did a couple of times, get above this 36, you have to be long because you can't miss this move. You need to participate. For someone like me, that I'm not missing this move because it's going to be huge. So I'm willing, even though the dollar wasn't breaking, it's like, okay, still have to buy it because it's breaking out. The technicals there. I don't love it because you don't have the dollar going yet, but that things could change, and we can see these relationships can break down for certain periods of time. So you never know. It could be a thing where silver goes up and all of a sudden the dollar goes down, and that's why silver was going up. That's not the way it happened. Now this is much more natural and much more powerful. So I like silver a lot right here, literally today. Now, of course, the thing about it, Jordan, and I know, come next week, the story could be completely different. So who knows? It could be they have a trade deal with China, stocks are rallying, and nobody wants to own precious metals anymore.
Yeah, lots of false moves in precious metals, but I'm not seeing it this time. But okay, finally, Greg. So if silver takes out 36.50, then what's the next target after that?
Oh, it's $50 easy. And like I have said twice before, that hasn't worked out. All right, wrong or early, either way, it's you're not right until you're right. And in this case, I think that it's not a question of do you get $50, it's how fast you get there. Because I mean, how many people are out there that have bought silver, lost money, and are frustrated and are not going to get sucked in on this move again? I'm not getting sucked in by silver again. No way, And next thing you know, it's $40 and they're going, shit, it's the move. So to me, that's the kind of thing that could happen here. So I think and ultimately, I mean, I've said this before, if gold is, headed to 4,000, I have a long-term target still. I mean, much longer term. We're not talking next year, but a 3 to 5 year target that I put out when gold hit my first target for this year, which is 26.50, which seemed ridiculous in January when I put that out there, right? Now it's not so ridiculous. Now everyone's bumping up their targets. But when we hit 26.50, I redid all the math and reprojected everything going forward. It's all mathematical, Ellie wave type stuff. 49.45 is the next upside target for gold in my mind. That's going to take a while to get there. But I mean, if gold's going to test 4,000, I have no problem seeing silver testing $100.
There you go, Greg. All right, before we see you off to your tea time, last thing, please tell our listeners where they can go. Where can our listeners go? How can they contact you to subscribe to your research, and how can those who are interested in your money management program contact you?
Sure. Thanks, Jordan. Appreciate that. Just email me, Greg Weldon, GregWeldon at weldononline.com. We do the global macro strategy report, which is global bonds, stock indexes, all the currency markets, precious industrial metals, energy. And I'll tell you what, the food commodities are going to be hot going forward too, for all kinds of reasons. And this is why, to me, being a CTA, I have access to the long and short side of all of these assets out there. And being involved in food commodities is going to be a lot better way to keep pace with the inflation in food prices than being long stocks. Stocks will go up when the dollar goes down, but it won't keep pace with the debasement of the purchasing power of the currency. So in places like Argentina or Pakistan or Turkey or even Nigeria, where the stock market makes new highs all the time, as the currency crashes, are the people better off? No, the standard of living is going down. So in that case, that's the way inflation works. So I think it's going to behoove people greatly to, find a good CTA and put, 10, 15% of your money with a CTA will give you an edge in trying to keep pace with everything that's coming next. Or if you're a do-it-yourselfer, the research is a great product, to my way of looking at the markets. We have, like I said, from the top hedge funds, we got retired, individual traders down here in Florida. I got one guy who lives just north of here. He's 84 and he loves it and he trades all the time. And, we do well with those kind of people too. I would also say I did a 60-page special, and each page is a giant chart, so it's not hard to read. It's not a bunch of text on the bond market crisis, the U.S. debt black hole, and all of this, and how this benefits gold at the expense of the dollar. And by the way, Jordan, I think one of the biggest things that people don't watch and should watch is what I call the gold adjusted dollar index. Really simple. All right. You're talking about the dollar index divided by the price of gold. It's not hard, right? But if you go back to 71, when we went up the gold standard, you can see this is a pretty good gauge of the purchasing power of the U.S. currency, just measured and an ounce of gold. Just took out 3 cents on the 1973 dollar. Okay. So you can continue to debase that by another 90% and then debase it again by another 90%. This is the kind of thing that it can go on in perpetuity. So again, I think that, when you want to see stuff like this, that's where the research comes in. I also did a big special on platinum we just did. I did a special on uranium recently, which I also really like. The supply-demand fundamentals of uranium are phenomenal. There have been some issues, with the price and Trump and all this, but that is small ball compared to the big ball trade that is the uranium market as well. So you get information on any of that, any of those special reports. I especially recommend the bond report. When you see the charts of debt of the consumer, when you're talking about public borrowing, okay, the government borrows money in our name, and then they print dollars, okay, the proceeds of the bond sales that they're selling the debt back to we the people. All right. The public owns, public holdings of public debt is 80% of the 36 trillion in public debt. Use the P word for that. I kind of think you could. At the end of the day, you're in a black hole that you can't get out. You have to print more money to keep the economy going. And that's the biggest secular macro story that has changed in the last 5 years. That is a major trend that was going to last probably for a couple decades.
Got to leave it there, Greg. You're the best. Thanks so much for coming on. And, hope we can do this again in the next couple months. And I hope you hit them long and straight out there today.
I'll be outside. Hitting them long and straight really doesn't come into the game anymore. It's more about just getting out of the house and being out in nature for an hour or so late in the day. So we'll see what happens.
Sounds good. Thank you so much, Greg.
Take care, Jordan.